Hi there and welcome to Investing Basics Asset Classes Unpacked. The reason we put this video together with the follow-up videos is really just to explain to investors who are investing in financial products who tend to get confused between the characteristics or the features of those products with the underlying investments. And really what we're trying to say with this and the subsequent videos is that every and any financial product invests in one or more of an underlying group of asset classes. In our world, there are really only 4 asset classes, and we recognize that some other people would include commodities, for example, as a separate asset class. But in our world, there's really 4 key or primary asset classes. Firstly, cash. Secondly, bonds. Thirdly, would be property. And lastly, would be equity. Now, sometimes you get a situation where you have certain financial assets that have got elements of both or 2 of these underlyings, but they almost always have one dominant characteristics. So firstly, looking at cash, it's not a complicated asset class. It's really just the money market or the short end of what they call the yield curve, generally seen to be deposits with banks and big financial institutions. Unfortunately, the returns of these assets on cash or money markets very, very low, but also the risk is low. So generally people see cash or money market investments as short-term parking bays, and I think most people would admit that after tax and inflation, the yields are actually, or returns are negative. Then onto bonds, and I think bonds have a wide variety of issuers and maturities and different types, but really when we talk about bonds, we're talking principally about the government debt market, and then you could also include some of the parastatals in that. But yeah, yields on bonds slightly higher than you would get on cash, as you would expect to be compensated for the longer investment horizon, because often bonds are issued with 20, 30-year maturity terms. And then obviously as they go on, they do trade in the secondary market, and that unfortunately exposes the investor on the positive side to some liquidity, so you don't necessarily have to hold it for the 20 years, but at the same time it does expose the investor to some risk, because ultimately bonds are very sensitive to interest rates. The capital values move in the opposite direction to the interest rates. So in other words, if interest rates are going up, it would mean that bond prices are actually going to fall. So I think most people generally see bonds as a very low risk investment, and while that is theoretically true, investors need to remember that if you're not going to hold it to maturity, you do expose yourself to quite a lot of interest rate risk, and by virtue of that, quite a lot of capital risk. Then property, most people are familiar with property as an asset class. It doesn't really matter whether you're talking physically, directly only owning a building, or if you go in through, you know, a listed property company or a fund. Ultimately, they all hold the underlying property. There are a couple of challenges with property. Firstly, if you only have one building, you've got what we call a lot of concentration risk. Secondly, property tends to be what they call very illiquid. It's very difficult to sell it quickly. And then lastly, the big challenge with property is it needs active management. So it's constant repairs and maintenance, you're managing the tenants and so forth. Over time, the returns are twofold. Firstly, you get a net rental. So in other words, the surplus rental that's generated after you pay your rates and taxes and utilities and so forth. And then secondly, you have capital appreciation. Capital appreciation comes from a couple of sources. Firstly, and most importantly, your rentals would go up every year in line with inflation. And then secondly, the landlord or the property owner has the ability to improve it, and through that also improve the value of the property, or the capital value. We believe that listed property and unit trusts and funds that are liquid overcome a lot of the traditional, so the liquidity and concentration risks of property. But it's very important to remember that although property is a good long-term investment, on the short term it is quite sensitive to what happens in interest rates. Then on equity, by far the most complex and diverse asset class, and the one that we here at Kerner Perspective spend probably 75 or 80% of our time on. It's really from a very wide range of risk-return profiles, so from companies that are what you would call high dividend paying, through to companies that are highly speculative or aggressive growth companies. And it's that diversity of and range of risk return profiles that attracts us most to equity, because it's almost possible to get any sort of profile matched with some form of equity. Returns are twofold. Firstly, you get dividend yield, which in the last few years has compared very favorably with what you would get after tax on cash. And then secondly, you have the prospect of capital appreciation or depreciation. Very importantly, ultimately, equity is totally dependent on the performance of the underlying company, and very importantly, the level at which you come into those assets. So in summary, cash is a great short-term parking bay. It protects you against corrections in other asset markets, but on the long term, we believe it's value destructive. Bonds are theoretically very low risk, but we believe on the longer term are actually very risky, particularly if you are facing a rising interest rate environment. Property is an excellent long-term inflation hedge, but it is geared to what's happening in interest rates, and sometimes property markets do dislocate somewhat from the fundamentals. It's important to recognize those times. Equity is by far the best performing asset class on the long term, but brings with it a lot of vulnerability to market fluctuations on the short term. And it's important to remember that a big determinant of your underlying performance in equity is driven by, one, what you buy rather than just the market, and secondly, the price that you pay. So we hope this has helped to shed a little bit of light on asset classes, and next time you're looking at a financial product, just think about what that underlying product is investing in and refer back to this. If you need more information, there'll be a few more videos in more detail on each of these asset classes. We hope this has helped.